Welcome to the Deep Dive. Today we're cutting through the noise of a really high-stakes Q3 2025 earnings call. We're looking at a key player in the ADS space, that's Advanced Driver Assistance Systems, specifically in high-resolution radar. Now, this call happened pre-market on November 17th, and what was so fascinating was this huge split, this massive narrative divergence we saw. You had management on one side, just unwavering in their strategic confidence, but on the other side, you had the market, which reacted with, well, immediate and sharp disappointment. The stock traded down heavily. Our job here is to give you the shortcut to understanding why those two worlds are just miles apart right now. Okay, let's unpack this. We have to start with the financial headlines because that's really what drove the whole initial reaction. The results, they kind of paint this classic picture of a pre-scale tech company, high ambition meeting some tough near-term reality. On the bottom line, the results were a little mixed. GAAP EPS was a miss, came in at negative 10 cents. Consensus was looking for negative 9. But, and this is important, but management clearly put some strong cost controls in place. So the non-GAAP, or the adjusted EPS, that actually beat expectations. They managed to tighten that loss to negative 8 cents, which is better than the negative 10 or 11 cents the street was expecting.
That EPS beat, though, was completely and totally overshadowed by the top line. And this is where the market just went cold. Revenue. The company reported just $300,000 in revenue for the quarter.
0.3 million.
Exactly. Now, yeah, that's technically a 200% increase year over year, but it's from a tiny, tiny base. The real story is that it was drastically short of what anyone was expecting. Consensus was sitting somewhere around, $640,000 to $700,000?
Wow.
So that's a massive 60% revenue miss.
60.
That's the single number that explains the whole reaction. An adjusted loss beat, that suggests good housekeeping. But a 60% revenue miss, that suggests the path to actually scaling this thing is way, way slower than anyone thought.
And that lumpiness is key. So how does a company that's focused on something as big as level 3 autonomy get blindsided by a 60% revenue shortfall?
It connects right to the stage they're at. They're not mass producing sensors yet. They're still in that validation and engineering phase with the car companies. So that divergence, the tighter loss versus the huge revenue miss, it's just a sign that they are completely exposed to the timing of these NRE programs.
Okay, let's go a bit deeper into the financials because despite that tiny revenue number, they did show some signs of efficiency. Operating loss narrowed a bit, negative 11.5 million, down from 12.4 million a year ago. And gross profit, while it's still negative, it improved slightly. So they're getting a little better at the fundamentals, right?
They are, but this is where you have to look past the GAAP numbers. What's fascinating here is the nuance in the actual cash burn. While those operating loss figures look a bit better, the adjusted EBITDA loss, which gives you a much better feel for true cash consumption, that actually widened.
Oh, right.
It went to negative 9.2 million. That's up from 8.2 million the year before.
So wait, the GAAP numbers look better because of things like stock compensation coming down?
Exactly. But when you look at how much cash they're actually burning every quarter to run the business, that rate has ticked up a little. And 9.2 million a quarter it's a lot for a company bringing in 300,000 in revenue.
That is a staggering asymmetry. And it brings up the big question, how long can they keep that up? But this leads us to the huge mitigating factor, the one thing management kept pointing to, their bedrock. The balance sheet.
The balance sheet.
The company is holding $52.6 million in cash and equivalents.
Mm-hmm.
And if you stack that up against their full year guidance, they reiterated an adjusted EBITDA loss of negative 29 to 35 million. That cash pile gives them a really significant runway.
It's easily 2 years, maybe more.
Right.
And this is the critical trade-off that you, the listener, need to get. That 52.6 million isn't just a number. It's the financial foundation that lets management basically dismiss the Q3 revenue miss as just a timing issue.
They can afford to.
They've bought themselves the time to survive until that production revenue finally starts. Without that cash, this earnings call would have been a total disaster.
Right. They're essentially saying, look, we solved the financing problem. Now we're 100% focused on winning the actual business.
Mm-hmm.
And that strategic focus just dominated the entire call. Management was clearly way less interested in Q3 than they were in hammering home their strong strategic progress.
They're positioning themselves as the key enabler for level 3, eyes off, hands off autonomy. And for our audience, it's probably worth clarifying what level 3 really means here.
Yeah, this isn't just your fancy cruise control anymore. That's level 2. Level 3 is that pivot point where the legal liability, it shifts from you, the driver, to the car itself under certain conditions.
And for the car to take on that liability.
Its sensor suite has to be basically infallible. It needs redundancy. It needs incredibly high resolution to map everything around it. And that's exactly where this high-res 4D imaging radar comes in, because it sees through fog and rain in ways that cameras just can't. Which is why the design win narrative is everything for them.
Everything. Management said they believe they're in the lead for a major Level 3 program with a big European OEM.
And they expect a decision soon.
Very soon. And their bigger goal is it's incredibly ambitious. They're aiming to secure 4 OEM design wins over the next 3 quarters.
4 wins in 9 months. That's a huge target.
Yeah, it's a massive target.
Which brings up the big question. How can they be so confident about winning these huge contracts when they just admitted that those same OEMs are slowing down the decisions that generate their current revenue? I mean, is that just wishful thinking?
It's a fair question, and that's the core tension of this whole story. Management tries to justify that confidence by pointing to, objective validation, not just hope. They listed off a few things. First, industry awards. They won the 2025 AutoTech Breakthrough Award, a Just Auto Excellence Award. These aren't just participation trophies, They signal that outside experts think the tech is special.
And they're also pushing the tech into other areas, right? Not just cars.
Exactly. They highlighted expansion into defense and marine. There's a new boat collision prevention system called WatchIte. What that does is it provides another validation path. It proves the tech is rugged and accurate outside of the notoriously slow automotive testing cycle. And third, and this might be the most important long-term, is their collaboration with NVIDIA. They're working on the Drive platform for AI-enhanced mapping.
Being tied into the biggest computing platform in the space is a massive advantage.
Oh, a huge advantage. It just makes it easier for car makers to adopt your system.
So, okay, you've got this undeniable tech validation on one side, but it's set against this undeniable macro headwind. Management even admitted it, saying that, economic shifts are causing OEMs to postpone new models, stretch out decision timelines.
Which perfectly explains the 60% revenue miss.
Right. And that pressure immediately showed up in their updated guidance for 2025. They had to cut their full-year revenue guidance pretty dramatically, down to a range of just $1 to $2 million.
And they blamed the entire cut on timing shifts in those NRE programs.
Let's pause on NRE, non-recurring engineering. That's the lifeblood for companies this stage.
It really is. It's basically the upfront fees the car maker pays the supplier to customize the tech for their specific car. It's the cash flow you get before mass production starts.
So when NRE gets pushed from 2025 into 2026, it's a clear signal that timelines are stretching across the whole industry.
Exactly. But here's the interesting part. Despite cutting revenue guidance so much, they reiterated the 2025 adjusted EBITDA loss guidance.
Wait, hold on. How does that work? If the revenue that actually has margin is shifting out, shouldn't the loss get wider?
That's the exact tension the Q&A focused on. Management basically confirmed that the huge variability in Q4 revenue depends entirely on when those customers sign the checks. If that European OEM decision comes through soon, they hit the high end of that $1 to $2 million annual guidance. If it gets delayed, that revenue just shifts to early 2026.
So they're betting they can control their internal spending no matter what.
Right. They're confident in their expense controls. But the timeline is everything. They maintain that meaningful production revenue is still on track to start in 2027 and then ramp big into 2028 and beyond.
That 2027 ramp is the finish line. But the huge caveat is that it is completely contingent on them securing those 4 design wins. So for you, the investor, the debate is framed perfectly. Can this company go from being a radar science project with awards to a commercial platform with booked programs?
Before that $52 million cash cushion gets eaten up by those $9 million quarterly losses.
Exactly. And this is where it gets really interesting. You have this clear narrative divergence playing out. You've got management's story,
which is, the tech is validated, we have the cash, we have the pipeline. This quarter was just a timing speed bump. Growth starts in 2027.
And then you have the market story,
which is, short-term execution failure. A 60% miss means we can't trust your timeline. And that cash burn is a rising risk.
The market sees the speed bump as maybe a structural flaw.
Precisely. And you can see that divergence in the stock price. Over the last year, this company has sharply underperformed its peers. The SOXX semi-index is up, 20-30%? The QQQ is up 20%. This stock is lagging badly.
And it reflects those company-specific concerns. Dilution from capital raises in late 2024 and early 2025 to build up that cash pile.
And just the constant lumpiness of the revenue.
So the whole situation boils down to this: high dilution, but high optionality. The next 3 quarters are completely binary for the company's valuation.
Those 4 design wins are the only bridge that gets them to that 2027 revenue ramp.
So as professional analysts here at Talk Tickers, we always have to consider the crazy volatility of these stories. Let's shift gears. This is our speculative institutional segment. And we need to be clear, this is not financial advice, but we're pitching an outrageous but plausible trade idea based on this report. What have you got?
Okay. The thesis centers entirely on that cash runway and those binary design win events. The stock is going to be dictated by the announcement of that European OEM win, which could come any day, and then the next 3 wins after that. That $52.6 million in cash provides a hard floor against, immediate collapse. It doesn't guarantee the revenue ramp, but it buys them time.
Okay, so what's the trade?
The trade is to sell deep, out-of-the-money put options that expire about 6 months from now. So just beyond the window they've set for those 4 design wins.
Selling puts. That's a bold move right after a huge miss that sent the stock down. You're betting against total collapse.
You are. But you're monetizing the extreme uncertainty, the super high implied volatility right now. The rationale is this. You collect a fat premium from people who are terrified of a total implosion after this revenue miss. But you're betting that the balance sheet holds out long enough for at least one of those positive announcements to hit. If they announce that European OEM win, for example, volatility will crush, the stock rallies, and those puts you sold expire worthless.
So you're selling the uncertainty.
It's a classic sell the uncertainty trade in a high optionality name like this. You're betting against total failure while hedging against missing a huge rally on a big announcement.
Okay. So we've covered the strategic advances, the level 3 positioning, the awards, that big cash cushion, and we've set that against the immediate challenges, the 60% revenue miss, the lowered 2025 guidance. The entire focus for the next 9 months now shifts completely to whether management can hit that ambitious target of 4 OEM design wins.
So what does this all mean for you?
The core takeaway is patience. You have to have patience in the face of these macro delays. The structural demand for high-res radar and level 2 plus and level 3 cars is absolutely rising. There's no doubt about it. But the global macro environment car makers slowing down new models to save cash is putting enormous strain on pre-scale suppliers like this one. They're caught in this perfect storm of technological need versus delayed decisions.
Okay, so give us one last provocative thought to chew on. All right, here it is. Given that all of these global OEMs are delaying timelines and tightening their capital budgets, does that pressure ultimately force them to consolidate their technology partners sooner than later? Think about it. If capital is scarce, they might move from testing 3 or 4 different radar vendors to just selecting a single primary supplier for all their high-res radar needs.
So the winner takes all.
Or at least the winner takes most.
Right.
Does that make the potential prize of securing one of these 4 design wins even more valuable for whoever gets it? What does that pressure cooker environment mean for this company's valuation over the next 12 months?
A lot to think about. That's all for today's deep dive.